Okay, in this first video we're just going to be doing a bit of a recap of some of the demand side factors we've been looking at in class, and then start looking at how some of these supply side factors can also impact economic growth. So first of all, we'll look at the exchange rate. As you can see, over the last 2 years, so these graphs both start from January 2018, you can see there's been a noticeable declining trend in the value of the Australian dollar. That's both from a compared to the US dollar perspective and also the TWI, or the trade weighted index. So basically the trade weighted index measures the value of the Australian dollar compared to a basket of foreign currencies. So there's been a clear downward trend. The dollar has clearly depreciated, so that's what you need to be focusing on in your answer. And it's from around 80 cents to around 70 cents in terms of the US dollar. If you get to ask how this trend in the value of the Australian dollar is likely to impact the goal of inflation, okay, the key things you want to do is identify the trend, so that it's been a downward trend, the dollar has been depreciating, make reference to the values, so it's gone from around 80 to 70 US cents. Identify that a depreciating dollar increases the cost of imports, so talk about it from a supply perspective, and that can lead to increased costs of production for businesses, and that can increase inflationary pressures. And secondly, that it increases the demand for exports. So the flow-on demand for exports and also import competing firms also creates more demand. So the demand curve is essentially shifting to the right for Australian products, and that can create more inflationary pressures from a demand perspective as well. So from demand perspective, there's more demand. It also leads to imported inflation in the form of higher costs of production, which can both lead to inflationary pressure. In terms of linking it to the goal, you could argue that because Australia is at the bottom of our goal, so we're sort of at 1.92% inflation at the moment, you can argue that Australia is not really experiencing inflationary pressures, and therefore that's unlikely to hurt the goal at this point in time. Interest rates is something we've talked about in class. I just want to make it clear how you can structure your answers to interest rate questions at the moment, because even though interest rates are quite low, they haven't fallen this year, and they've actually increased in terms of the interest rates that we pay on consumer loans and business loans. So here's just a hypothetical question. How have interest rates in 2018, 2019 impacted the goal of strong and sustainable economic growth? How would you go about doing that question? Well, first you define the goal of strong and sustainable growth. There's always a mark that asks you to link it to the goal. Make it clear that interest rate settings have been low, so the cash rate stands at a record of 1.5, which is a record low, and then make your links to consumption and investment. So consumption is likely to be increasing because of the fact that low interest rates increase discretionary incomes, and they also increase consumers' willingness to borrow. So those with existing variable rate loans have more discretionary income. Those that are considering borrowing are more likely to borrow because their borrowing costs are lower. This has positive impacts on investment spending as well, because firms have more cash flow and they're more willing to borrow as well. So overall demand increases because of more consumption and investment. In terms of aggregate supply, the only link you want to make to aggregate supply is that firms with existing loans have lower costs of production because they don't have to pay as much interest, and that makes them more willing to supply. That's the only link to supply. So you would say that in combination, those two things should support the goal of strong and sustainable growth. However, a really good way to approach your answer would be to say that the banks have actually increased their rates on consumers' loans. So the fact that even though the cash rate's at record lows, the rates that we're getting charged as consumers have increased slightly, and that's not because of the RBA changing theirs, but the banks essentially changing their rates. And secondly, consumers have become more reluctant to spend any increases in discretionary income, and both of those things have limited the effectiveness of low interest rates. So the fact that they've increased slightly on consumer loans, and the fact that people are less willing to spend their increase in discretionary income, have both made interest rate cuts less effective. Last thing you could talk about is consumer sentiment. Consumer sentiment has grown slightly in the last 2 years. So if you look at that graph, there has been a bit of a positive trend. But if you wanted to focus on one negative, you could mention that housing prices going down as a negative demand side factor. So if you get asked a question, how does the trend in housing prices over, let's say, 18-19 is likely to affect the goal of strong and sustainable growth and low inflation, what you want to do is identify that house prices have begun slowing and now they've dropped in 2019. Use data if you get a chart. Outline the effects on household consumption, so the fact that lower house prices make consumers less confident, it's likely to increase their marginal propensity to save, and it's likely to reduce consumption spending. And then make the links to the demand of both goals. So decreases in aggregate demand make it harder to achieve the goal of strong and sustainable growth because there's less demand, and therefore businesses are going to lower production because of the lack of demand. And secondly, that less demand for products is likely to lead to lower inflation because there's less demand pull inflation or less spending on goods and services. So make sure you define both goals really briefly. Identify that house prices have fallen. That's reduced consumer confidence and spending, and that flows on to less growth and less inflation throughout the economy. Overseas growth, again, if you get a question on that, if you're getting to link it to the goals, just make sure that you identify that weaker global growth hurts our net exports. Talk about the lack of demand for commodities, mainly, that leads to reduction in aggregate demand, and then you link it to the two goals. It will reduce production because there's less demand, it reduces prices because there's less demand for inflation, it can lead to more unemployment because there's less demand for resources because of the reduction in growth, and more underemployment because firms might cut hours instead of sacking people as a result of the reduction in demand for their products. Okay, supply side factors. So the next part of this video, we're going to start looking and honing in on some supply side factors that are impacting growth. So we've got our demand factors, income taxes, interest rates, the dollar, consumer confidence, overseas growth. Now we're going to start looking at some supply side factors. Okay, just be really mindful that if you are asked whether something has grown or fallen in the last 3 years, so if it's like productivity or real unit labour costs, if most of the graph is above 0%, then overall that factor has increased. There's a difference between slower growth and a decline in something. So make sure that if productivity growth is slowing down, but it's still above 0, that you refer to it as slower growth, whereas if it's below 0, then you can refer to it as negative growth or a fall. Just a couple of things. I did mention this really in class, but when you're talking about supply side factors, make sure that you mention key things in your answer. That if it's positive factors, that it increases profitability, it makes firms more willing and able to supply, it helps to expand our productive capacity. They're your first links to either growth or employment. And your second link is that it helps to lower prices. So any positive supply side factor you can link to lower prices, increase international competitiveness, and that creates employment and income throughout the economy as well, which also generates more demand. Not a shift in demand, but an expansion in demand because of the lower prices. Okay, so some of the supply side factors we're going to look at, things that affect cost of production, like oil prices, labour costs. There are things that affect the quality of factors of production, like education. Things that impact the quantity of factors of production, like immigration, which we talked about in Chapter 4. And then also climatic conditions can affect supply as well. We'll focus a little bit on that as well. So, first one is slow wage growth. Low wage growth, basically, Australia's wage growth in recent times has been growing at around 2.3% in nominal terms. And essentially what that means is that's much lower than what it normally is. So we generally average wage growth of around 4 to 5%. And slow wage growth, even though it can be bad for demand, when you get a question on wage growth, if it's mentioned as wages as opposed to incomes, then you want to be focusing on this positive supply side impact of that. So the benefits of slow wage growth are that it helps to keep unit labour costs down, reduces firms' cost of production, makes them more willing to supply. So if we look at the wage price index, when you see the wage price index, this is measuring changes in nominal wages. So what that basically means is the change in actual wages. We're not adjusting for inflation, it's just what wages are changing by. So at the moment, nominal wage growth has increased slightly in the last year, but it's still around about 2.2%, which is much lower than what it was sort of in all this period where it grew at around 4%. So nominal wage growth is quite weak. Inflation at the moment is around 2% as well. So wage growth has increased only in real terms by about 0.2%. The other thing that you want to link wage growth to is unit labour costs. So when wages go down, that helps to reduce firms' unit labour costs. Couple of things with reading this graph, just because you'll see this graph quite a bit. Sort of if you look at this period in here, unit labour costs are consistently increasing. Even though there's ups and downs, it's always above 0. So unit labour costs are always increasing during that period. It's only during these periods that unit labour costs have slightly fallen. And the reason for that is unit labour costs, and I'll show you the ratio in a second, but basically unit labour costs measure your cost of labour per unit of output. So if you look at this graph here, when labour productivity grows at a faster rate than average earnings, that's when your unit labour costs go down. So here's your ratio so just in terms of what unit labour costs mean, basically your costs of labour are things like wages mainly or salaries, but it can also include money that firms pay for superannuation, work cover, payroll taxes, sick leave, so essentially all the costs associated with hiring people. We don't want labour costs to increase without increases in productivity. So firms are happy for their labour costs to go up, but they want productivity to grow at a faster rate. So unit labour costs go down. So your unit labour costs are the average cost of labour divided by average labour productivity. So as you can see, if the numerator goes up, then real unit labour costs go up. If the denominator goes down, real unit labour costs go up, and there are a few other variations which I'll talk about in a sec. So in terms of unit labour costs basically labour costs will fall if labour costs go down. If wages go down but productivity stays the same. If productivity increases but labour costs stays the same, then also your unit labour costs fall. And then there's some more complicated ones, like if labour productivity increases by a faster rate than labour costs, so the denominator increases faster than the numerator, or if they're both falling, labour productivity falls but at a smaller margin than what the wages are going down. That will all lead to a fall in unit labour costs. Okay. You'll also hear the word real unit labour costs. It's important that you know exactly how this, what this looks like. So it's the average cost of labour adjusted for inflation. So for example, we take out the fact that wages go up every year just because prices increase, and then divided by average labour productivity. So the key thing here is that it's just average cost of labour still, but you're adjusting for inflation, and then the denominator is the same, divided by average labour productivity. Higher rates of labour productivity help to reduce real unit labour costs, but it's not the only thing that can cause lower real unit labour costs. When real unit labour costs increase, it's an unfavourable supply-side condition because profit margins are eroded, and that discourages productive activity and reduces aggregate supply. In terms of the impact on growth rates, increased real unit labour costs increase costs for businesses. They lower profitability and lead to unfavourable supply-side conditions. A decrease in real unit labour costs is a favourable factor. It decreases firms' production costs, it increases their profitability and makes them more willing to supply. When you're doing questions, you can also link that to the positives for aggregate demand. So any decrease in real unit labour costs leads to lower costs of production. That should flow on to lower prices, and that helps to stimulate demand and net exports in the economy as well. The growth in unit labour costs depicted in the chart above, which I haven't shown you, I'm not going to worry about that one, sorry. So when referring to real unit labour costs falling or increased productivity, always link it to the fact that when you're linking questions to growth, always link it to the fact that it leads to lower prices, it boosts our international competitiveness and creates more employment and consumption and jobs throughout the economy. So here's a couple of potential questions. So explain one supply factor helping to boost economic growth in Australia in 2019. So one supply side factor that's positive is the slow growth in wages. Nominal wages are growing at around 2% and real wage growth is just above zero. These lower wage pressures have helped to reduce firms' unit labour costs, reducing costs of production and making them more willing and able to supply. So that's your first link to the supply. It's also helped to boost our international competitiveness by keeping prices down, and that makes us more competitive, and that flows on to more net exports, increasing demand and more production throughout the economy. Okay. A couple of other questions. How is it possible for real unit labour costs to fall even when labour productivity growth has been negative? And basically it's possible for real unit labour costs to fall even if labour productivity growth is negative if wages are going up slower than productivity. So even if labour productivity is only growing at a slow rate, if wages are growing even slower, that's possible. So for example, despite weak productivity growth of 2%, remember it's still growth here even though it's weak, if wages only grow by 1%, then real unit labour costs will still fall. With wage growth of only 1.9%, Australians can experience weak productivity growth and still experience a reduction in real unit labour costs. And lastly, distinguish the wage price index from real unit labour costs. Tricky question, but basically all the wage price index does is measures an increase in wages from one year to the next. So it's just looking at wages, whereas it doesn't take into account productivity. It's just looking at whether wages are going up or down. Where the real unit labour costs are a measure of wages but is divided by productivity, which gives an indication of whether businesses' cost of wages per unit of production is actually changing. Okay, and that language is really important. One is just looking at overall wages, the other one is looking at what are the wages per unit of production. Thank you.